Before we begin, it's my pleasure to introduce our speaker for today, Chin Yixuan. With a background of degree in economics from University Malaya, currently Yixuan is the general manager of Algopedia Sendirian Berhad, which is a proprietary trading firm in Malaysia specializing in algorithmic trading. He has over 5 years of content creation experience on personal finance and investment via his personal blog called nomoneyla.com. Besides that, Yixuan is also featured in various media platforms. So without further ado, I am delighted to hand over the presentation to Yixuan. So Yixuan, there you go.
Good evening, ladies and gentlemen. Welcome to my sharing session on order flow today. My name is Yixuan from Algopedia. And before we start, just a quick disclaimer. This presentation is provided for general information only. It's not intended as an investment advice, offer, or solicitation for the purpose or for any sales of securities, stocks, futures, or investment products. Stocks, securities, and futures imply risk and to be undertaken only if you understand the risk. Please seek your own tax, legal, and financial advice before investing in stocks and futures. So all information in this presentation is subject to change without any notice. All right. So first of all, welcome everyone to the session today. As you know, we are going to talk about order flow. Now, let's go give you guys a brief overview of what we are going to talk about today. Number one, I'm going to introduce to all of you why price move and what is order flow exactly. Secondly, I'm going to share with you why order flow matter in your trading. Number three, we are going to talk about how to use order flow tools like the depth of market, or in short, DOM, and volume profile to improve your trading. And number four, I'm going to give all of you some examples and principles of how to use order flow. And lastly, I'm going to share with you how to practice reading order flow. Now, first of all, a question to everyone. Have any one of you heard of order flow before? If you have heard of it, just type in the chat, say yes. If no, if you haven't heard of it, just type no. No, right? I think most of you are pretty new. I think most of you are pretty new to this order flow. So you know what? Let's get started. Okay, so some of you might be wondering, whenever you look at search for professional traders or trading related articles or content, right? You tend to see photos like this, right? Where some of these traders, right in front of them is this red and blue thing, right? Which you are most of you tend to not be familiar with, right? I think most of us traders, when we first started learning about trading, the first thing that we come to know is the charts, right? The candlesticks, typical candlestick charts that we are very familiar with, right? Some of you might be wondering, why are some of these professional traders that you see, they use this thing which we call the depth of market or ladder, right? Or as for me, I call it DOM, right? Why are some of these traders using DOM? Or more important question would be, what are retail traders like ourselves missing, right? What are the information that we are missing from not knowing how to read the DOM? So without further ado, I'm going to share with you why. Before that, before I move on, I just want to share with everyone a quick expectation setting. Number one, unlike most sharing session on trading, I'll cover the fundamental lesson first. So if you have notes or notebook with you, I highly recommend you to take some notes. Secondly, especially for traders that have learned technical analysis by using indicators before, I highly recommend you to learn with an open mind, because there's a lot of things that we can learn together. Number three, I will go slower because this is a very new topic. Please be patient with me, and I promise it will be worth it. Number four, of course, there will be practical application at the second half of the sharing session. Okay, so now let's go straight into this. What is order flow? Okay, to understand order flow, I'll share with you, we need what is a market. We first need to understand what is a market. So as an example, I'll use a watermelon market as an example. So let's say me buying a watermelon from a watermelon seller at 5 ringgit per piece. So this is what we call a transaction, which is an action of exchanging an asset. In this case, we are a product or service for money. In this case, it's a watermelon, right? I'm buying a watermelon for 5 ringgit per piece, right? But we all understand in real life, there's not just one consumer and there's not just one watermelon seller, right? In a real life market, there are many more consumers or sellers, right? And there are many more watermelon sellers in the market. Okay. And not only that, there are also as such, right? A market. This is where I want to introduce everyone to the concept of the market. The market, right? If you simplify it, it's actually not as complicated. It's actually a gathering of buyers and sellers participating in a transaction. So what does this mean, right? So this means, right, at the market is where buyers and sellers come together and make and do business, right? As simple as that. And not only that, aside from as per real market, watermelon are not just sold at 5 ringgit, right? There are always different prices that are where a product is being sold. As an example, some sellers may decide that they want to sell their product at 5.50. Some watermelon sellers might decide they want to sell their product at 6 ringgit, right? So as such, this is a definition of market, not as complicated as it seems. But now I have a question for everyone. How does price move? Right? So because there was a myth when I first started to learn how to trade, right? At least from platforms like YouTube and so on, right? They tend to have a idea or concept when a certain indicator happens, right? Indicates something, this is where price move, right? So people, especially new traders, they tend to rely on indicators to tell them when to buy or sell. And they assume that it's because of indicators price move. But I want to show you with this example that is actually not the case. Okay, so let's use back the watermelon example. So in this case, right, at 5 ringgit per piece, let's assume that there are 4 buyers and there are 3 sellers. Okay, so what happened if all the 3 buyers have cleared off the supply at 5 ringgit? Okay, this is where what will happen to the 4th person? Anyone? A good guess? What will happen to the 4th person if this person wants to buy a watermelon? Exactly, right? They want to buy at a higher price, right? So in order to buy a watermelon, the 4th person will need to move on, right, to buy at the new market price of 5.50. Okay, so this is exactly how price move, right? This is actually very resembles how price move in the real life market and even the financial market, as I'll show you later. Okay, now that we understand how price move, I also want to show you that there are also aside from buyers making decision, right, in the market, the sellers, right, that supply the watermelon can also make decisions. So what do I mean by this? So let's say the weather got hot, right, and there are more people wanting to buy watermelon, let's say at 5.50. Now at this point, if the watermelon seller have yet to sold off his supply, this seller could say, you know what? I noticed that the weather is getting hotter, the demand is getting higher. Why not I shift and sell my watermelon at a higher price, right? What's stopping him or her from doing this? Nothing, right? So as such, right, the decisions of buyers and sellers in this market, right, is what we call order flow, right? Formally, we call I define order flow as a collective decision-making process by all the participants in the market, right? The buyers and the sellers. Okay, so this essentially, ladies and gentlemen, is order flow. Now, that I described to you just now in the watermelon market is actually very, very similar to the financial market. So what do I mean by this? Okay, on your left is the example, watermelon market example that I showed all of you just now. On your right is part of the depth or market, or DOM as I would like to call it. This is something that for those of you who trade stocks or futures, right, you tend to see something like this when you log into your trading platform. right? And here today, for the first, we are going to talk about DOM a lot, right? I'm going to share with you how to use the DOM. And firstly, understand how the DOM works. Okay, now let's jump into this first. Well, how does real life market resembles a financial market? So remember just now, right? Me buying a piece of watermelon at 5 ringgit per piece is actually, in financial market terms, it's called market order, right? I buy the watermelon at 5 ringgit is an actual demand. So as an example, as such, when you look at, oops, sorry. Okay, as such, if you look at this part of the DOM, the price right now is 37.05, right? So what happened with what does the bracket on the right side means, right? So this means that at 37.05, there were one contract or one futures contract traded at 37.05 previously. So this is what we call the market order, all right? Now what does then, how about, okay, then how about the sellers, the watermelon sellers, right? These are what we call in, when it comes to the futures of stock market, this is what we call the pending sell order, right? These are the people that are trying to sell the watermelon to you at 5.50 and 6 ringgit. So when you look at the DOM on your right side, right? If you may focus on my cursor for a while, right? This red column over here, the 15, the 7, the 12, the 4s, right? These are essentially what we call the pending order, the people that are waiting to sell to you, right? They haven't sell it to anyone yet, but they are ready to sell at, let's say, 37.06, 37.07, 37.08, if buyers come to them and make a deal with them. So this is essentially how close, right, real life market, like even a watermelon market, resembles the financial market. Okay, so I hope you get the sense of how everything works so far. Okay, now not only that, one of the awesome thing about the financial market is you have the flexibility to make money or to profit when the market is going down, right? Especially in the futures market, you can take a short trade when the market is going down and you can make a profit. So this is where, if you look at the dark blue column, right, it is essentially what we call the pending buy orders, right? These are, imagine if the dark red column on the right are the sellers waiting to sell to you, right? The dark blue column on the left are the buyers that are ready to buy from you if you are the one selling. Okay, so essentially, right, just remember the dark blue color is the pending buy order. The dark red color column on the right is the people that are waiting to sell to you, i.e. the pending sell order. Okay. Now, to quickly summarize what we have learned so far, I want to break down what a DOM or depth of market is, right? So first of all, on the dark blue column, as we have talked about just now, we have pending buy order, which is the buyers waiting to buy from you. Okay. And secondly, we have the pending sell order, which is the sellers waiting to sell to you. Okay. Now, we also have at the market order, which is the actual demand. So right now at 37.05 and the right bracket 1, right, it means that implies that there were one contract of futures traded at 37.05 previously. So this is what we call the market order. Now, some of you might be wondering, you know what? How about the column on the far right, right? The column on the far right is what we call the volume profile. So don't overcomplicate things, right? It's essentially, it tells us that it displays the trading volume, right? Actually, the actual demand that happened at each market. So as an example, right, at 37.05, there were 167 contracts traded at 37.05. This is essentially what it means, right? Okay. So now that I've shared with you a brief introduction of the DOM, I want to test everyone what we have learned so far. Okay. So let me just play this video for a quick moment. Now, some of you, if you are on your laptop or desktop, you might be able to see. Okay, so please join me, right? Right now, the market is priced at 1434, right? 1434. So my question to you all that are watching, how can price move up from 1434 to 1434.5? Okay, I repeat my question. The price right now, the market price right now is 1434. How would a price move up from 1434 to 1434.5? By doing what? Anyone want to take a quick guess? Yes, exactly. Some of you got it right. In order to move up from 1434 to 1434.5, the traders or the buyers will have to clear out the pending sell order at the 11 pending sell order at 1434. Make sense? In order to move up, right? The buyers will have to clear out the 11 pending sell order in order to move out. Make sense? Right? Just like the watermelon market. So with that in mind, let me just quickly, I want everyone, I will play this video and I want everyone to focus at around the 1434 price point. Okay, just focus at the price point. Okay, let me play the video. Okay, observe how in a moment the pending order at the 1434 will be cleared. Okay, so as you can see, I just pause it. So at this point, right, all the pending orders, as you can see just now, there were like 11, right? It's now cleared, and price actually, the pending order has been cleared. And what happened next is price would move up to 1434.5, right? So this is where you can actually see the transaction happening. So imagine yourself as like, you take an aerial view at the watermelon market, you see a transaction happening. This is what you are seeing with the depth of market or DOM, right? Interesting, right? Interesting information that you have, right? Compared to conventional price chart. All right, now. Okay, so I have another question to all of you, right? Today, so far, we have learned about market order and pending order. My question to all of you is, although both are important, which one is a more crucial piece of information when it comes to your trading? Any good guess? Okay, some of you say pending order, some of you say both, right? So I would like to give you my own perspective on this, right? So market order essentially will you agree that market order is actually an actual transaction that has happened, right? I.e. the buyers actually buying the watermelon, right? In other words, right, a market order shows aggression in the market. This shows that people have the intention to do business in the market. So meanwhile, on the other hand, a pending order, right, i.e., in this case, the watermelon sellers waiting to sell from you. These are market participants with a passive intention in the market. These are people that are waiting for, let's say, in this case, buyers to go to them and make a deal with them, right? So in this case, right, when you compare market order which shows aggression and pending order that shows a passive intention, right? Market order, in my opinion at least, right, is something that is an information that is more crucial. Why? Because I showed you just now, right? Someone that sells watermelon at 550 can suddenly change his or her mind to sell at 6 ringgit instead. So this pending orders can change, right, in the split second. Meanwhile, market order is actual people clicking the buy and sell button, if you imagine the financial market, right? Make sense? So in my opinion, market order, right, though both information are important, but market order is a more significant information in your trading. I'll show to you why in the next part. Okay, so before we move on, just I want to quickly break down again what is a DOM, right? Market order and pending order. So translating to a financial market from the watermelon market. Okay, so the dark blue and the dark red column, right, is the pending orders. The blue meaning referring to a pending buy order, which is the buyers waiting to buy, right? The red referring to pending sell order, the sellers waiting to sell to you. Imagine a watermelon market, right? So these two columns, right, are what I call the passive intent column. These are people waiting to make a bid, waiting for market for people to do a deal with them. So these are people that's waiting on the sideline. Okay, what's more important, in my opinion, is actually the volume profile column, right? The volume profile column. Sorry, I was trying to pull out the pen. The volume profile column, as well as the price, the market order, the pricing that shows where market order happens, right? Why? Because this records the actual executed market, right? Or volume in the market. This shows aggressive intention, i.e. the people that's actively clicking the buy and sell button. Make sense? All right. Now, okay, now my next. So now that we have learned about the basics of the DOM, right, and also what is a market order and pending order, we also learn about what are actually more important. What does market order mean, right? Aggression. Pending order, that means a passive intent in the market. Now I will show all of you, right? We are coming to a more, I would say, a practical application of order flow in the market with all these tools knowledge that we have learned so far. I'll share with you two order flow nuances or patterns that you can see with a DOM, right? Or you can spot with a DOM. So first of all, is what I call spoofing. Okay, spoofing refers to large pending orders that give a false impression of a strong support resistance, but it is pulled off from the market. It can be pulled off from the market last minute. So I actually saw the chat. Some of you, I think one of you asked a question just now. Why, just now in the example, right? Instead of like 13 or 15 initial pending sell order that's being cleared off, there are only 5 that was being cleared off. This is the result I'll share with you right now. So for everyone, now let's pay attention here. Okay, so at right now, this is a price or a DOM of crude palm oil. Okay, so I want to share with you an anomaly here. Okay, so on the dark blue column, right, the pending buy order, we see like a 228, 86, 11, right? So there's an anomaly of 86 orders lying out at 38.35, the price of 38.35. So this is actually a larger than usual buy pending order, which give traders an impression, if they are looking at the DOM, that there's a strong support at 38.35. Now observe what happened in 30 seconds later. So right now the initial screenshot is at 11:57:52. Exactly almost 30 seconds later, what happened when the price got to 38.35, ladies and gentlemen? Sorry, give me a moment. The volume, the pending order suddenly disappeared. Okay, the pending order suddenly disappeared. And is there any new volume recorded in the volume profile? It's still 89. So this is what I call spoofing, right, in the market. So spoofing is a very interesting concept because it gives people, traders, a strong impression, right? Where some retail traders that do not have an idea about spoofing, right, they tend to think, oh, there's like a strong support at 38.35. Let's front run, right? Let's enter at 38.36 or 38.37, knowing that there could be people supporting the price at 38.35. So people that don't understand spoofing, traders that don't understand spoofing, they will get trapped into this kind of order flow pattern. Okay, now let me now just I show you like a screenshot. Right now, let me show you the actual video of how spoofing happened in real life. Okay, now give me a moment. So in this video, I'm going to show I want everyone to actually focus on the price 38.35. Okay, 38.35. Focus on the price of 38.35. Okay, now let me play the video. So 38.35, initially there were only 7 pending buy orders, right? If you can see, you can follow, right? Let me play the video, right? Notice in a moment, suddenly there's a large pending order coming in. Stick with 38.35, right? Okay, I'll stop here. See how within a split second, suddenly 80 plus orders coming and lying out at 38.35. Now, the next thing that I want all of you to observe is as price goes down to, let's say, goes down to very got very close to 38.35, let's say at 38.36, right? What happened to the 86 buy pending order, pending buy order? Okay, let's observe. Okay, we are 80 plus orders still at 38.35. Okay, let's wait for price to come down to 38.35. So as you can see, let me just replay this for you, right? At that split second, let me just replay. Okay, right now, the buy pending order is still 89. It's just happened at a split second, right? When the market got to 38.36, the buyers, the pending buy order of 80 plus just decided to take off their orders. So this is what happened in front of you just now is what we call spoofing, right? What is essentially, because why is spoofing such an interesting topic? Because anyone can put in a large pending order, right? And they can take it off anytime. So what I'm trying to tell everyone here, the lesson that we can learn here today is pending order. When you see like a pending order, right? Especially the large pending order, always take it with a pinch of salt. Some may be true support that's happening, right? But on the other hand, there are also a lot of spoofing happening. Okay, so always the key takeaway here is take spoofing or pending orders, especially the larger than usual pending orders, with a pinch of salt. Okay, now that we have learned about spoofing, I want to introduce to all of you the next pattern that you can spot on the DOM, right? Which is absorption. So to define absorption is essentially orders being continuously added to create an impression of support or resistance. What do I mean by this? So as example, let's go back to a watermelon market. So as example right here, 3% has already cleared off the supply of watermelon at 5 ringgit. So usually, right, from what we have discussed today, the 2% that's lying behind, in order to get their watermelon, they will have to go up to buy at 5.50. Make sense? Right? Because there are no more supply, right, at 5 ringgit. But absorption happens when instead, once the moment where the watermelon supply is clear out at 5 ringgit, new supply come in, right, and take in all the demand from the other side. So as an example, in this case, 2 watermelon come in and take on the 2 buyers' demand, right? And once that's done, new supply come in again and absorb any demands that's coming at 5 ringgit. Okay, so essentially think of absorption as a sponge, right? At each price point. So let's say in this case, the 5 ringgit, right? Sellers, they just keep on absorbing the buyer's demand from the market. Okay, this is what we call absorption. Okay, so to show you what's happening in the financial market, to help you understand how it works in the financial market, I want everyone to just focus on 38.40, the price of 38.40. Give me a moment. 38.40 is here. All right, 38.40, and the volume profile recorded a 174 contracts traded at 38.40. What happened is, I'll show you a video later, but let me go through the plan with you, what's happened to you with you first. Buyers try to push through 38.40, right? They want to push higher. But what happened is, once they clear the one pending order, right? Sellers come in with another one pending order. You know what? They were like, you know what? Let me take on more demand at 38.40. And then once the buyers clear off the demand, the buyer clear off the pending sell order again, right? Sellers come back in with more pending sell order. This caused price unable to push up, right? This caused the buyers unable to push up the price from 38.40 to a higher price. Okay, so this is what we call absorption, right? Imagine if you are just trading from a conventional candlestick chart, right? Without looking at the DOM, right? These are all the crucial information that you are missing, right? Crucial piece of puzzle that you are missing from your decision making. Okay, so very, very interesting stuff. Okay, now let me show you a video edition of what I described just now. So give me a moment. So this video is about the crude palm oil futures, right? The FCPO. And I want everyone to focus on the price of 38.40 as we discussed just now, right? So let me just play first. Okay, at 38.40 right now, do you see that there are 157 volume that were traded, and there are around 12 pending sell orders lying up here, right? So let's play, and I'll on the way I'll pause and describe to you my thought process and the observation that I see. Okay, I'll press play. Observe as price got closer to 38.40, right? Focus at 38.40 and the volume profile of 157, all right? Okay, let's wait for a moment. The price would be moving closer to 38.40 soon. Okay, price is getting closer to 38.40. All right, it's coming soon. All right, let's stop for a moment. Okay, so what happened here? Remember just now the volume profile is of 157. So at this point, right, buyers has clear off the pending sell order, and the new total volume that's transacted at 38.40 is 174. So this means that there were transactions happened at 38.40. Now observe, starting from this point onwards, buyers will try to push above 38.40 multiple times, but for all the times, right, new sellers or fresh supply of pending sell order will come in, right? Take a look. Look at 174, right? Buyers try to push 176, 177, 179, 180, right? As you can see, right, it happened within a split second, right? What happened was buyers were trying to push through 38.40, right? But fresh supply, or in this case, the fresh pending sell orders just keep coming in. You know what? You want to buy? Okay, I'll take in the order, right? But as such, right, as a result, the market actually was not able to push through 38.40. So if I can just show you, right, what this means, right, in let's say charts, right, this means, right, sometimes you realize when price go up, it try to test the same level many times, right? But you in your pure price chart, right, that typical price chart that most traders use, they sometimes get frustrated, or they ask questions like, why are price not pushing through, right? And you are losing a piece of information because you may not know, right? The absorption is actually happening, right, in the order flow when you can look at the DOM, right? So this is a very, very interesting observation, and I highly recommend you to, consider putting this piece of information into your trading decision making. All right. So what we have learned so far is spoofing and absorption. Okay. So a quick takeaway from our session so far. Number one, indicators do not cause price to move. Number two, order flow is equivalent to collective decision making process by all the participants in the market, the buyers and the sellers. Okay. Market order equals to demand. Pending order equals to the supply. All right. So think of it as if whenever you look at the dark blue and the dark red column, right, the pending order column, these are the watermelon sellers, right? Okay. Lastly, price move up when buying demand is more aggressive than supply at a particular price level, and vice versa. Now, now we have just so far we have learned about, how to read a DOM, how to look at the spoofing pattern and also absorption pattern in the market. I want to introduce all of you to, again, a very important concept in my trading, which is auction market theory and volume profile. Okay, now coming back to the watermelon market, okay? So remember just now, I bought a watermelon at 5 ringgit, but with time, right, would you agree that we'll see a pattern where some people will buy instead of 5 ringgit, some people may buy at 450, some people may buy a watermelon at 550, because no one product is selling at just one specific price, right? In the supermarket, okay? And some may buy it at 6 ringgit, some may buy it at 4 ringgit, okay? So with time, you will see that price actually move in a range, right, of 4 to 6 ringgit because people are happy to transact between 4 to 6 ringgit. Now, if I draw this into like a bell curve, this is what we call the volume profile. Volume profile is essentially a visual record of where transaction happen, right? In this case, the transaction of watermelon happens between 4 to 6 ringgit. It shows us a range. Now, if I just show you in terms of like a price chart, you will see that the price tend to go in a sideways pattern, right? And this is where, now that I introduced you to volume profile, this is where auction market theory comes in. Auction market theory tells us that the market moves higher due to imbalances between buyer and seller aggression until a balance is achieved, or I call it a fair value. What do I mean by this? So imagine everyone is happily eating watermelon between 4 to 6 ringgit. Suddenly, a heat wave like right now happened, and suddenly people are demand towards watermelon increase. And what will happen if, because watermelon supply, there are only so much, right? So what will happen, ladies and gentlemen? What will happen when the demand is stronger than the supply? Most likely, the price will increase, right? In this case, there's a shift in value, right? People may start to buy watermelon at 10, right? Some may start to buy at 9 ringgit or 11 ringgit. In other words, right, there is a shift in value where the supply of, or the sellers of watermelon are offering their product at a higher value. So this is what we call a shift in value, right? Until a balance is achieved, right? They were transacting, they were testing, 10 ringgit, 9 ringgit, which one will people happy to transact? Until they achieve a balance up at between a range of 9 to 11 ringgit. So this is what we call auction market theory. Now, a question. Now, once the heat wave ended, right, everything goes back to normal. What will happen to the price of watermelon? Anyone? Now, once the heat wave ended, right, the price of watermelon, will you agree that it will go back to the prior fair value where people were happy to buy watermelon between 4 to 6 ringgit? Right? So this is what we call auction market theory, right? Price is always looking for a fair value. Price is always forming value, right? Okay. Now, I want to show you a shift in value in real life. So this is a Milo, right? A Milo product in 2020, right? What happened in 2020? COVID happened, right? In March 2020. So as you can see, prior to March 2020, okay, prior to March 2020, Milo was transacting between $16 to $20, right? And during March 2020, when COVID just right, there was a panic on food supply. And what happened was price actually spiked out and formed a new value around on above $25 to $30, right? And what happened once that when things got settled, right? People have more certainty over their food supply, right? Price, ladies and gentlemen, goes back to prior fair value where people were happy to buy. So what I'm trying to say, describe to all of you is that auction market theory happens, or how a market works, right? The pattern of market happens in not just real life, it's not just financial market, it also happens in real life. Okay. Okay, now, in other words, right, as you can see, volume profile is a very transparent and freely available tool for, especially for futures trader. Why? Because futures market, like in Malaysia, is things like FKLI or the crude palm oil futures, right? They offers transparent information on trading volume, which is accessible for all traders. So in this example, you can see, right, you could have imagined, right, the the price will sideways for a while, then it push out, it form a little bit of value, which you can see, right? The 29, the 63, the 58, the 42. And right now, the right price right now is 31.50, 14.31.50. So 14.31.50, and this is where price goes down, right? So you can imagine with just a volume profile, we could imagine or visualize how the price move in the price chart. Okay, now I want to move on to, now that we have understand volume profile, I want to share with you some trading ideas that you can finally, implement with alongside order flow in your trading. Especially for those of you who are new to trading, I hope this could inspire you to consider order flow in your trading. For those of you who are existing trader, you could use order flow to implement order flow to supplement your existing trading system. Now, the first trading idea I share with all of you is fading the extreme. Now, fading the extreme means, now, all of us saw volume profile just now. Now, fading extreme means essentially when the price take a long, when price reaches the bottom edge of the volume profile, and on the other hand, when the price reaches the top edge or top extreme of the volume profile, we take a short. Right, this is what we essentially, what I call fading the extreme, right? Because imagine, right, if there's no fundamental change in price of watermelon, right? Would you buy when the price of watermelon is at 4 ringgit? Usually it's sold at 5. Yes, it's a good deal, right? So this is essentially what we are doing right here, fading the extreme. Okay, so to improve this approach or strategy, consider watching the order flow as an entry confirmation. Number one, if you are looking to go long, okay, which is at the bottom extreme, right? Optionally, you want to see sellers trying to push down, all right? But buyers are absorbing them like a sponge, right? So sellers have a problem trying to break through. But more importantly, we want to see, when you want to take a long, right, you want to see order flow going in your favor, right? You want to see the other sellers, right, are clicking the buy button actively. Okay, so you want to see aggression from the buyers. If you are looking to go short, it's the other way around, right? You want to see buyers trying to break through but being absorbed, okay? But more importantly, you want to see sellers, right, in your direction, okay? Now, let's look at an example, okay? This example is from the crude palm oil futures, okay? Now, okay, let me pause the button for a moment. Okay, in this example, I want to just test everyone's knowledge from what we have learned so far. Could you identify where the fair value is? Well, give it a try. Okay, let's identify the context first. Okay, give me a moment. Okay, will you agree that the fair value is around 37.20? Oops, 20 to 37.25, right? This is where a bulk of volume happen at the we can see where volume happen at the volume profile. Now, what happened right now is price is at 37.12, right? This is what we call the extreme, right? If I may draw it here, the extreme of the volume profile. So this is where I would potentially consider stocking for a fading the extreme trade from the bottom extreme. Okay. Now, give me a moment. Now I will play the video. I want all of you to observe, right? As I play the video, price will push up to 37.15, 37.16, right? And I'll pause it again. I'll continue with my description later. Let me play the button. Okay, price push up from 37.12 to 37.15 and 37.16. Now, right now, I'll share with you what I have in my mind, right, in this analysis. Okay, I saw at 37.15 they were 130, right, which is a higher than usual volume traded at 37.15, right, 130 contract traded. Now, my observation right now is I want to see when sellers try to push down again, right, could the level of 37.15 be defended, i.e. the buyers want to defend that level, right? And if that happens, I also want to see buyers aggressively, right, coming in aggressive clearing off the pending sell orders before I enter fading the extreme trade. Now, take a look. First of all, you take a look at 37.15. Price will try to test it a couple times, but it will fail, right? It will test a couple times. You test once, you test twice, right? 37.15, hold it grounds well. Okay, right now, this is where once a multiple test of 37.15 happen and it cannot break below 37.15, and I see that aggressive clearing of the pending sell order, right? This is where I enter my extreme fade trade, right? At around 37.18, right? Let's see what happened. Okay, once I enter at 37.18, it tried to push back again. Again, 37.15 would most likely, I want to see if it holds. If it doesn't hold, then my trade is wrong, all right? So where would I trade it until? I would most likely trade it until around 37.22 or 37.23, which is the middle of the volume profile where fair value forms. So look at 37.23 or 37.22, right? Price will eventually go and test there. All right. So in this case, right, we make about about 4 to 5 points. Okay. So this is an example of what I call the fading the extreme example. Okay. Now the next trading idea that I want to share with all of you is what I call trading the breakout. Okay. Trading a breakout essentially is trading the breakout when the price pushes through the fair value or volume profile. Okay, and form another new volume profile. Okay, so essentially in this case, when I want to go long on a breakout, this is where I would long, and when I want to short, this is where I would take a short. Okay, so again, you could use order flow as an entry confirmation, right? Ideally, if you go long, you want to see aggressive aggression from buyers, i.e. buyers clicking the buy button, right, before you enter. Optionally, you want to see sellers trying to prevent, at the edge of value, right? Sellers trying to prevent buyers from pushing through but fail, right? This is definitely a good sign. If you're going short, on the other hand, you want to see sellers, right, being very aggressive, right? Optionally, you want to see buyers trying to prevent them from pushing down, but they fail, right? So an example. Okay, so before we continue, before I click play, let's form the context of the situation first. Now, would you agree that this volume profile is kind of like something like this, right? So there are bulge volume at 38. There are bulge volume at 38.37 to 38.40, and then it goes down and it forms another big value on the bottom. So right now, price is in this small bulge of volume over here, right? So my plan, as you'll see later, is it will break down, right? Will break down, and I would be trading it into the prior fair value. Okay, now let me show you what I mean. Okay, now let me press play. Okay, now as we press play, I also want you to pay attention to the price of 38.35, right? Remember, 38.35, they were like larger than usual buy pending order lying out here. This gives traders that have no order flow knowledge that, oh, there's a strong support here, when price goes down, I probably there's a strong support preventing me from taking a short. So what have we learned today, ladies and gentlemen? There's a possibility of spoofing, right? So right now, my game plan is I want to see when price goes down to 38.35, is this 85 buy pending order, are they legit, right? Will they just pull out their order, or will they fulfill their buy pending order, right? If they do not fulfill their order, i.e. they pull off, the spoofing happen, right? It will give me a more conviction to take a short. All right, let's take a look. Observe 38.35, all right? As price got close to 38.35, this will be a slightly long video, right? Okay, as price got close to 38, 35, can you see what happened? Right, the 80 plus buy pending order become 4, right? Meaning buyers have very little conviction to defend, right, the level. So this gives me initial confidence that, oh, okay, this short might work, right? But I want to see aggression from the sellers, right? I want to see, let's say 36 and 35, right? They are the 2 and 4 buy pending orders being cleared, right? Before I take a short. All right, price is still at 38, 36. All right, let's wait. So right now, my game plan is I want to see the 5 and 13s, right? The buy pending order, the dark blue column being cleared off. All right, so I see right now, as you can see, in that split second, price moved down to 38, 34, which means sellers are clearing off all the buy pending order. So this is a signal for me to take a short, right? So right now, essentially, let me show you what happened, right? Right now, I'm taking a short, all right? I'm taking a short back into the prior fair value, right? Which is here, okay? So right now, once I take a short, where would I ideally plan for my target profit? Most likely in the middle, right? Somewhere in the middle of the fair value, which is around 28, right? 28 is around somewhere here, right? This is a more conservative target profit, okay? So, but because of time, I most likely wouldn't play the whole video, but just understand that I hope you find it useful when I go through my thought process with all of you, okay? Now, a quick one. Why should you add order flow to your trading? What are the benefits? Number one, for those of you who are struggling with your win rate right now, because example, whenever you enter, your stop loss immediately get hit, right? Or you have a very poor hit rate in your strategy. Edit, right? Number two, it also can reduce low that are not or comfortable. Some of you are trading using, let's say, support and resistance. Whenever price hits support, ideally you want to go long, right? But right now with order flow, you can see if whether buyers are aggressively hitting the buy button, right? If they are doing so, then it's an additional confluence to your entry. Okay. So on the other hand, right, with order flow, you can also identify high quality trades that are confirmed with or confluenced by order flow. Number four, whether regardless of what trading system you are using, let's say Fibonacci or MACD or RSI, right? You don't have to use volume profile of, though hopefully I hope you would explore that, but you could use DOM, right? The depth of market, right? In your trading, right? It's not difficult, right? And lastly, at advanced level, right? A trader can use order flow to manage a trade, you know. There's a saying that pro traders always add on to their winners, right? One of the way traders can use to add on to their winners is through order flow. Though I think this could be a topic for the future. All right. Now, quick principle on how I use order flow. Number one, order flow is not perfect. It can be misleading. In fact, it can be misleading many times, right? If you do not know how to use it out of context. So example, things like absorption and aggression happens inside fair value a lot, right? So what I'm trying to say, what I'm trying to say is things like this, right? So if you are trading in this volume profile, right? Price, when you trade inside a sideways pattern, what could happen is you see a lot of absorption, you see a lot of spoofing, you see a lot of aggression inside the chop, inside a sideways pattern, and you can get chopped a lot. So order flow is not a perfect tool, right? In fact, I would say for most traders or most trading style, order flow, you should not use order flow on its own. So as such, my suggestion, use order flow in tandem or with context. So for those of you traders that have learned about trading, right, you know, right, context is the most important thing, right? So 90% context, Only use order flow for those of you who are new to improve your trading entry, right? You want to see aggression from the in your favor, okay? So example, when you fade at the extreme of value area, which is the context, you can use order flow as an entry confirmation, all right? And so, okay, how to practice reading order flow? My suggestion, especially if you are new, right? Practice with a thicker market. Example here is the FKLI futures over a thinner market such as the FCPO or crude palm oil futures. Why? Let me show you an example, right? The reason, what do I mean by a thicker market? A thicker market refers to a pending order that is, sorry with the flow, I'm not sure why the drawing is like this, but nevertheless, a thicker market refers to pending orders where there are more pending orders on lying out, right? When you compare to the FCPO, which is on the right, there are only a single, most of the pending orders are in single digits. What does this mean essentially? Essentially is market with a very low or single digit pending orders, right, tend to be cleared off very easily, right? Because imagine you want to clear off a price level with one pending order compared to you want to clear off a price level with, let's say, 50 pending order. Which one is easier? Obviously, the one pending order is easier to clear, right? So this means, right, thinner markets like FCPO, they tend to move very fast. The DOM that you are seeing move very fast. You can't learn anything, right? So for new traders that want to learn order flow, you want to observe order flow, learn to observe order flow at the thicker market like the FKLI futures. Okay, let me show you an example. Let me show you an example over here. So on your left, you have the FKLI futures, which is a thicker market. On your right, you have the FCPO market, the crude palm oil futures market, which is a thinner market. Thinner market move faster, right? So I want you to look at this. You can visualize for yourself, right? Look at how fast the FCPO market move while the FKLI market is just very, very steady, right? You see how fast the FCPO market move, right? FKLI just moved, right? You could see it very easily, but for FCPO on the right, it moves so fast, your eyes cannot catch it, right? Okay, so I hope you understand why I suggest you to start practicing, right? At least in the thicker market first before migrating to a faster market, all right? Oops, sorry. Okay, aside from that, right, a few key tips on what you can observe, what you should observe for while looking at the order flow pattern. Number one, aggression at key level. So let's say you want to do a fade the extreme trade, right, at the extreme of the volume profile, right? You want to see, right, if you want to take a long, is other buyers supporting your narrative, right? Other buyers supporting your trade idea, right? If other buyers are stepping in and clearing off the pending orders, yes, then this is where you come in, right? Secondly, you want to see things like absorption, right, in your favor. So let's say you want to take a long. Ideally, you want to see prior to the movement, right? Sellers are trying to push down, but they fail, right? They keep getting absorbed. Okay, this is something that add confluence to your trading. And number three, spoofing, right? You see a lot of this, and most of them are especially obvious, right? Example, the 80 plus pending orders that we see in our discussion just now. Okay, so observe how this false impression of support or resistance are formed in larger than usual pending order, just for them to be pulled out, right, last minute in the split second. Okay, so these are some of the three things that you can learn to observe. So key takeaways before we end. Number one, order flow can be used to improve your entries, even more so at trade management when you are at an advanced level. Okay, and number two, order flow knowledge can be integrated in your existing trading system to improve your trading precision. Number three, practice. If you want to learn about order flow, please practice with a thicker market such as the FKLI, because your eyes can catch the movement at the DOM. Okay, so this is pretty much it. I think I have shared everything I need to share today, and thanks for having me. And there's a Q&A session, but I'll pass the session back to CY moderator first.